Hello, welcome you all on board AFM Advanced Financial Management. The name is Rashaad Hussain with ACCA's AFM topics. This is that of the valuation. In the year 2006, Google acquired YouTube. How much did it acquire YouTube for? Google acquired YouTube for $1.65 billion. How did they arrive at this $1.65 billion? Even though most acquisitions involve a combination of different valuation approaches, Google's acquisition of YouTube, discounted cash flow analysis of future cash flow, was one among the valuation methods adapted. My aim here is to simplify the few tricky adjustments of valuation. So here we have advanced financial management, tricky topic, and our topic is valuation. What in valuation? Where it's a big area, we are specifically looking into the valuation of an acquisition, and after acquisition, looking into how the value added happens. How do we calculate it? What are the tricky things? Where do the students go wrong? Now, there are various valuation methods. We've got asset-based models. We've got market-based models. We've got cash-based models. In asset-based models, to name, we've got the book value, we've got realizable value, we've got replacement cost, and finding the value, the intangible value, we've got CIV, which is calculated intangible value. At market-based models, we've got the P ratio, the earnings yield, the market-to-book ratio, the top and skew. Cash-based models, we've got dividend valuation model. We've got free cash flow. We've got free cash flow to equity. We've got APV. Our tricky topic focus is on free cash flow. What is it? It's on free cash flow. How do we find valuation as per free cash flow? Free cash flow would be discounted at WACC to give us, what is it, the value of the business, from which we are going to less value of debt in order to arrive at what? The value of equity. This is how we arrive at value of equity. So what is it? The free cash flows are discounted at WACC in order to arrive at the value of the business. Less value of debt is going to give you value of equity. Now, if one company acquires another company, let's say A company is acquiring B company in a totally different industry, not the same industry. A is acquiring B. A is called the bidding company. B is called the target company. How do we find value? What are the steps that we are supposed to follow? We are supposed to take the provided beta equity of both of these companies and arrive at their beta asset. De-gear it, remove the gearing, get beta asset of both the bidding and the target company. Then we are supposed to get the average beta asset of these companies. Once you get the average beta asset, come on, gear it again. We're going to re-gear to get the new beta equity that is applicable for this combined company. This new beta equity shall be substituted in order to get CAPM. From CAPM, we'll find out WACC. And once this WACC is found out, the free cash flows of the combined company, A, B, plus if synergy, if any, what is it, using the free cash flows, of what is it, A plus B plus synergy, if any, using all these free cash flows, will be discounted at WACC. And when we discount it at WACC, what we get, the present value, what we get is the value of business. From the value of business, we will less value of debt, in order to get, what is it, the value of equity. So we are going to pick up an activity where we're going to see the tricks that could happen when you do this case. So let's pick up an activity. Gizmo company plans to acquire a Danny company in a different industry. For how much they're acquiring? 130 million. They're acquiring for 130 million. This is entirely financed by a new debt at 5%. Gizmo has shares worth 200 million, debt finance of 50 million, with a cost of 4% pre-tax and an equity beta of 2. As a consequence of the acquisition, so post-acquisition, what is going to happen? The credit rating of this Gizmo, the bidding company, is going to fall, and the interest rate paid on existing debt will rise. So it's going to rise from where 4% to 5%. So it's not going to be any more 4, it's going to be 5%. After acquisition, the post-operating cash flows of Gizmo's existing business will be, for 3 years it is given. First year 10 million, second year 20 million, the third year 30 million. Danny has shares worth 100 million, debt finance of 20 million with interest rate of 5%, which shall be taken over by Gizmo. The debt is going to be taken over by Gizmo. Danny company has an equity beta of 3. After acquisition, the post-tax operating cash flow of Danny's existing business will be, year 1 it is 5 million, year 2 it is 15 million, year 3 it is 25 million. Post-acquisition, there will be a synergy of 5 million post-tax per annum, all the years. Risk-free rate is 2%, the market risk premium is 5%, corporation tax is 30%. Required, calculate post-acquisition value of the group and evaluate impact on shareholders' wealth. Is the shareholders' wealth going to increase or reduce? Assuming that the cash flow after year 3 will grow at 2%. So it's going to be 4 onwards into infinity, 4 onwards into perpetuity. There's going to be a terminal value. So how are we supposed to start? Where are we supposed to? Yep, Gizmo is taking up, is acquiring Danish. The beta equity of both of these companies are given. We will have to arrive at beta asset of both of these, get average beta asset, go find out the new beta equity. After the new beta equity, substitute that in CAPM, get the WACC. These cash flow of Gizmo and Danny, these two cash flows plus synergy, get those total cash flows, free cash flows, discounted with this WACC to get value of, what is it, value of firm. From that, less debt to get what, the value of equity. This is the step that we are going to do as we proceed ahead. These are the steps that we'll be doing as we proceed ahead. And let's start. Where are we starting from? Yeah, let's get the capital information. Let's get equity, debt, and the solution moving ahead. We get the equity of both the companies. Equity of Gizmo 200, Danny it's 100, debt is 50 for Gizmo, 20 for Danny. Beta equity 2 and 3. This is information that is given in the question. And assuming that debt is risk-free, we are going ahead to calculate, what is it, the beta asset for both the companies, beta asset for Gizmo and Danny. How do we arrive at the beta asset? How do we arrive at the beta asset? Beta asset is equal to, what is it, beta equity into value of equity divided by value of equity plus value of debt into 1 minus tax. So we get that beta asset is 1.7 for Gizmo, and for Danny we get it as 2.63. Now we are supposed to find out the average beta set or the combined beta set, and what weights are going to be used. We're going to use the total asset value of each company. The value of this together, how much is it? This is 250. The value of this together, how much is it? This is 120, and 250 plus 120, how much is it? It's 370. So that's what we're going to apply. How are we going to apply it? Yeah, combined asset beta based on relative value of the asset. Relative value of the asset is going to be used as a weights. So the Gizmo value, the Danny value, the total is going to be 370. Using this as a weight, finding out the average beta asset or the combined beta asset. We get the average beta asset as how much? 2. Now, once we find out the average beta asset, let's re-gear. Let's bring in all the debt into the structure, including the amount that we've further taken loan in order to buy Danny. What is the funding that we've done? Equity is both the equity together 200 and 100. The debt 50 plus 20 plus 130. We've taken a loan of 130 in order to buy Danny. And once we re-gear, how do we re-gear? What is the formula for re-gearing? Beta equity is equal to beta asset into value of equity plus value of debt into 1 minus tax divided by value of equity. Substituting the value into this, we get the new beta equity as 2.93. New beta equity as 2.93. The beta equity as per the post-acquisition capital structure. Now we're going to be using this into CAPM, and once we find CAPM, let's get the WACC as well. So substituting that into CAPM, we get it as 16.67, and then moving ahead for the WACC calculation, substituting it into the WACC. And one more important thing to note is that many cases students take KD as 5%. No, it is not 5%. 5 is the interest that they are paying, and the cost is supposed to be always post-tax. Do not forget to reduce 1 minus T, which would give you 3.5%, which will give you 3.5%. Now we need to compute the post-acquisition WACC. What are the columns? Fund, value, proportion, cost, WACC. So taking the equity and debt, what do we get WACC as? We get WACC as 11.4%. We get WACC as 11.4%. Okay, once we find out WACC, let's get the cash flows. Let's discount it with WACC to get the value of the combined company. Yeah, we need to find out. And when we take free cash flows, remember, we need to take off Gizmo plus Danny plus synergy. There are many times synergy is missed out. So we have got year 1, year 2, year 3, and 4 onwards. Infinity, what do we have? Into 1 plus G, and here what do we have? The WACC minus G into the previous year discount factor will help us arrive at the combined post-acquisition value. Combined post-acquisition value is 564 million. From this, what are we supposed to do? Reduce value of equity. Come on, let's go ahead. Reduce value of equity, a value of existing debt, 70 we have reduced. We get combined value of the equity. From this, we have paid some money to buy Danny. How much have we paid to buy Danny? We have paid 130. Reduce that 130. It's going to give me Gizmo's post-acquisition value of equity. This is now how much Gizmo is worth. Let's reduce the old value of Gizmo. Pre-acquisition value of Gizmo equity. Pre-acquisition value of Gizmo was only 200. The shareholder value added is 164,000. Or 164 million. Shareholders value added is 164 million. So what the students write is, yeah, shareholders wealth added is 164 million. Hence, that's it. Accept. You want professional marks, you have to bring up skepticism. You have to bring up commercial acumen. What are you supposed to write? First, you need to write that, yes, since the shareholder wealth is added, the Gizmo shareholders will be ready to acquire it, subject to, yeah, what are the comments? Let's see what are the bare minimum things that you're supposed to write. The proposed acquisition would increase the value of Gizmo shareholders by 164 million, and the shareholders of Gizmo would approve the acquisition. First thing, Danny is supposed to sell it, yes or no, subject to Danish shareholders' acceptance of offer. Now, this is not sufficient for professional marks. For professional marks, you have to bring in skepticism. You have to doubt the thing what is specified in the question. And how can you put it across? See, this is based on, what is it? It's based on the free cash flows. What if the free cash flows, the free cash flows to be realistic? If it is not realistic, if the estimate is not accurate, the entire picture will change. So how do we write in order to fetch those professional marks? The valuation is based on free cash flows are assumed to be reliably reliably estimated. And then what do we have? Other critical inputs such as assumptions, that is, the free cash flows increase at a constant rate of 2% after year 3 onwards, might not be realistic and could be subject to fluctuations. So what are the things that are needed to be taken care of? What are the tricky adjustments? One, synergy. Take care. Do not miss the synergy. Synergy is supposed to be included in the post-acquisition cash flows. Next one, calculation of beta equity. Several times errors are noticed while calculating beta equity from beta assets. Cost of debt. When you calculate cost of debt, do not forget to reduce 1 minus tax. It has to be made post-tax. Miss to adjust tax for the cost of debt and WACC calculation. Perpetuity terminal value. Since the perpetuity does not start in the first year, it has to be multiplied by the previous year discount factor. So we've seen error in present value approach whenever there is a perpetuity terminal value. The students or the candidates are generally able to calculate the discounted cash flow of the combined company, but many candidates, they forget to discount the perpetuity by, in our case, by the year 3 discount factor to bring it back to present value. And finally, the last thing is the value of equity. To arrive at the value of equity, please understand that you are supposed to reduce the value of debt. So there are several cases where they miss to adjust the value of debt from the combined value to arrive at the value of equity. It's surprising that a number of candidates, they forget to present their conclusion, or some don't even present their answer in any form of report. Any form, not even one single line. And they lose valuable marks that are relatively easy to achieve. As a next step, you can go into the study hub and try the activity of chapter 8 under the type 3 valuation. So what is it? Under study hub, valuation, type 3 valuation, which is chapter number 8. What activity are you supposed to do? The loopy juice. The activity that you need to look into is the loopy juice. Okay, well, good luck for your AFM exams. Ensure to go through the technical articles and the examiner's report. Wish you all the best. Thank you.